Good morning and good afternoon and welcome to the dissects Asia Midday Market Watch. I'm Samantha Voon and it is the 31st of May today. We are joined today by Kelvin Wong, Senior Market Analyst at Oanda in Singapore. Kelvin, good afternoon.
Hi, good afternoon to you, Samantha, and happy Friday.
Happy Friday. All right, so before we get into it, let's have a look at the regional stock market performance today. Ooh, okay, so we have the Nikkei 225 in Japan up 1.02%. In Shanghai, it is up 0.27%. In Hong Kong, the Hang Seng is up 0.84%. In Australia, the ASX 200 is up 0.48%. In South Korea, the Kospi is up 0.48%, and the STI in Singapore is up 0.24%. But in KL, the KLCI is down 0.10%. Kelvin, share with us what you think of the markets today.
Yeah, sure. So if you look at the current intraday performance on the majority of the major US benchmark stock indices, I would say is that it's a rather positive tone, given that we do see a slew of negative movement in the last 2 days in the benchmark US stock indices. So it seems to us that there's a bit of underlying intermarket factors that's at play, and bear in mind that the majority of the Asia major stock indices do have a kind of a correlation with the US dollar movement. That means, i.e., the dollar strength or dollar weakness that sometimes drive this intermarket relationship between the dollar and the Asia stocks indices. So if you look at, very interestingly, the US dollar actually yesterday gave a bit of pullback, strength pullback that was seen at the start of this week. So that is actually a pretty much encouraging intermarket factor that caught on a bit in today's Asia session. So later we'll discuss more also about another factor which is out from Japan, which is the Tokyo CPI data, and as well as the retail sales that came in better than expected.
Mm-hmm. Well, so let's just get into it right now. So we
Sure.
saw the upbeat Tokyo CPI data, right, for May, and the Japanese retail sales for April, just like you mentioned just now. That also, along with the
Yes.
rising Japanese government bond yield, how has it impacted the
Yes.
dollar-yen movement?
All right. So let's take things one step at a time first. So from an economic perspective, it's definitely an encouraging sign for the Japanese economy. Why? Because Tokyo CPI is actually the leading. We consider put it away that it's a leading city where it releases its CPI data 2 weeks ahead of the nationwide Japan CPI data. So given this is leading element, it do has a either a positive feedback loop or negative feedback loop towards the market, depending on whether it beat expectation or came in below expectation. So this time around, they actually beat expectation, and the margin it beat expectation is by a fair bit, because if you look at the Tokyo CPI excluding food and energy, in Japanese term they call it the core CPI, and this particular metrics is being monitored closely by the Bank of Japan to determine its next step in its monetary policy. And we know that right now the Japanese monetary policy makers are in the favor of rising rates rather than reducing rates. So what I could see is that the Tokyo core CPI, that's ex-food and energy, came in at 2.2% year-on-year for the month of May. So that's surprisingly very upbeat on the upside, because market is only expecting 1.6 year-on-year, and it also came in above last month April figure of 1.8%. So overall, being back up at 2.2%, it seems to us that the last 4 to 5 months of deceleration mode has started to turn around the corner. That means we are now seeing a much more stabilized in terms of inflationary trend in Japan, using Tokyo as the leading element, at hovering at the 2% mark, which is BOJ desired long-term target. And do not forget, CPI data is also driven by consumer spending. So if you look at the retail sales, which is considered as an indicative of consumer spending in US, also managed to recover remarkably for the month of April. So it came in at 2.4% year-on-year, above 1.9% expectation, and way above 1.1% that was printed in the previous month of March. So all in all, what we could see over here is that we start to see a very much more resilient data that is related to the consumer or the demand side of the things for Japan. That means what it relates to in terms of the next steps for BOJ monetary policy is that they are pretty much confident in a way that they could actually ignite another potential rate hike as soon as the next meeting in July. So you recall that on 19th of March this year, they actually totally removed, number one, the negative interest rate policy, and as well as that yield curve control on JGB yields, particularly targeting the 10-year JGB yield from allowing it to actually spike up above its upper reference boundary of 1%. So this 1% reference boundary has been removed. And what's interesting over here is on the 19th of March meeting, despite the removal of the YCC on the 10-year JGB yield at the upper reference boundary 1%, they do have a little caveat left, kind of stating that if the JGB yield, the 10-year, starts to rally up pretty significantly above the 1% milestone, historical milestone, they could come into the JGB market and buy up more JGB bonds in their so-called scheduled JGB bond buying operation. But based on the price action of the JGB yield that we start to see at the start of this week, and even if we take into account of since the end of March this year, it has been rising rather steeply and rapidly in terms of the pace of momentum. So as we are speaking right now, the JGB yield has really breached above the 1% historical hallmark on the 10-year JGB yield since I would say that Wednesday, since Wednesday this week. So right now it's actually trading at 1.07%. So that is seems to us that if previously in the past at this steep level of increase, the Bank of Japan will tend to come in and push down the JGB yield back below the 1% mark again. But it seems to us that they are not in aggressive in the JGB market now to actually put a cap on the JGB yield. So given the JGB yield right now is at 15 to 13 year for the 13-year high for the 10-year, and very similar movement for the 30-year as well, which is up to 2.23% right now as we are speaking. So that's about a 15-year high. And what's interesting over here is that the 2-year JGB yield is up a whopping 40 basis points for the start of this year. The start of this year is at around 0%, and right now it has spiked up to 0.4%. So that is the highest level since I think May 2009. So given the kind of movement that we witness right now in the JGB yields across the 10-year from the 2-year all the way up to 30-year, it seems to us that the BOJ hand is not so aggressive anymore as compared to the past in the JGB bond market. That means they are less aggressive in their bond buying program, allowing market forces to dictate the current pace of appreciation, which potentially translate to them that to us or to the market participants that they are actually in favor of normalizing their previous decade plus of ultra easing monetary policy, and which potentially could in turn see a bit of JGB strength revival. That means weakness in the dollar yen, at least from a medium term perspective, as we know that for those guys, speculators who use the carry trade, that means i.e. Carry trade strategy using the yen as a funded currency, tends to get more costly and unattractive if the JGB yield continue this current pace of appreciation.
Looks like things are getting better for Japan then. Yeah. So
hopefully.
So let's turn to China for a moment. So the China's National Bureau of Statistics, NBS, PMI data for May has already been released, showing mixed results, with manufacturing contracting as well, but the services activities expanded. So what do you make of this, Kelvin?
Yes, so what we could see over here is that it seems to us that at this moment in time, the current, we call it pace, and in terms of magnitude and in terms of the pace and magnitude of the current stimulus measure that is enacted by Chinese top policymakers doesn't seem to have pretty much impact on the manufacturing side of the activities. So what we could see over here is that given the rather still weak manufacturing activities or industrial production in China, there could be potentially more piecemeal stimulus measure coming into play going forward in the next couple of months. So something to keep an eye to look out for. So if this stimulus measure do come in the later part of June or July, potentially what we could see could be another interest rate cut enacted by PBOC. So the reason over here is that China also pretty much mindful of a weaker yuan as well to prevent any capital outflow. So if the dollar continues to dissipate in the next 1 month or so, perhaps the Bank of China, the Central Bank of China, PBOC, may actually reduce or monetary interest rate much further in the months of June or July. So that could be potential positive catalyst for the respective benchmark Hong Kong or Hang Seng indices, and as well as the benchmark China indices. So something to keep a lookout for any potential additional piecemeal stimulus measure coming up from the monetary policy side of things from China.
All right. Well, a lot of things are happening all around the world. Let's look at the US PCE inflation data expected to come out later today. Kelvin, what are you expecting from this release?
Okay, so this release, it seems to us a market participants are rather cautious right now, given that there could be a chance of a turnaround in the PCE inflationary trend, that was deceleration trend that was seen in the last 3 to 4 months. Why? Because if you look at globally, taking the Tokyo CPI as an example, the previous 3 to 4 months of deceleration trend in Tokyo has started to stabilize and turn around by a fair bit. And very similar that was seen on Germany core inflation data for May as well. There's also a turnaround after this 6 to 7 months of deceleration in Germany. So with that bearing in mind, market participants do expect a similar pace of increase for the month for US core PCE price data year-on-year price index on year-on-year basis, that's excluding food and energy, to come in at 2.8% year-on-year, very similar pace of increase at 2.8% for the month of March. So if the market continues to come in within this expectation at 2.8% year-on-year, I think that shouldn't be a big surprise. The only surprise that come in that if the PCE price index came in much hotter than expected, let's say at 2.9% year-on-year or 3% year-on-year for the month of April, so that is actually considered as a big significant reversal on the upside. That could actually see further potential downside on the ongoing pullback that is taking shape on the major US stock indices, given the fact that we could start to see a much more firmer US Treasury yield going forward, given the fact that since the PCE price index continue to actually remains potential of a turnaround, the US Federal Reserve could be more on guard of enacting kind of a aggressive interest rate cut, and who knows, perhaps that current higher odds of that first interest rate cut that's being priced in by the market right now to come in September could be pushed back further down the calendar again.
Okay, thank you for your insights, Kelvin. It's always a pleasure to have you here.
Most welcome.
We'll be speaking to Kelvin Wong, Senior Market Analyst at Oanda on dissects Asian Midday Market Watch. I'm Samantha Voon, and this video and podcast will be on our website, www.dissects.asia, as well as our social media platforms. It will also be on our syndication partners' TV stations and radio stations and website. Remember to like and subscribe. Thanks for tuning in.